Hello, everyone. Welcome to another mini series of the mini workshops of GTC Network. The GTC Network, it's a network for independent tax litigators. Together with me today, we have Hans from the Netherlands, we have Amelia from Ireland, and Gunnar from Germany. And the discussion will be around the tax risk on the IP onshoring structures. And on this session, the three panelists will give their views from their different jurisdictions. They will discuss some challenges that arise with the IP onshoring structures. And now I'll just give the floor to you, Hans. Would you like to kick off with a brief introduction?
Yeah, thank you very much, Marina. Yeah, just a few words. In the years, not too many years ago, it was clear that IP was often offshored in a location where the royalties and so on were taxed very mildly. And after the BEPS 2015 reports, that changed a lot. Of Action 2 about hybrids. CFC legislation coming in place in all the states, the principal purpose test has been relevant, but specifically Action 8 to 10, where IP valuation, the DEMPI functions, and so on and so became a core value for the future of transfer pricing. We also see it back in transfer pricing guidelines 2017. So companies are worrying about their position, and what we noticed the last couple of years that many companies which had an offshore structure are trying to convert into an onshore structure. For example, Airbnb moved its IP entity from Bermuda to the Netherlands for an onshore structure because it doesn't work anymore offshore, since the DEMPI functions make it hardly impossible to allocate too much money to that entity. That's the main reason why we believed with Amelia and Gunnar that because our three countries have possibilities for onshoring, that we would like to share with people watching the possibilities of IP onshoring from any position to Germany, Ireland, or the Netherlands. And probably Amelia, can you start with the views in Ireland and possible risks they might incur in Ireland?
Sure, thank you, Hans. So, hi everyone, my name is Amelia and I'm a tax partner with the Irish law firm Aina Goodbody. And we have seen quite a lot of IP onshoring activity over the last couple of years, with, as Hans has said, many US multinationals deciding to bring their IP onshore to various European jurisdictions. This has been driven by a number of factors, and I think when thinking about these, it's useful maybe to recap just very briefly on the offshore structures that were common in the past, particularly in an Irish context. So historically, many US multinationals held their IP in double Irish structures. This structure involved an IP holding company sitting below the US parent, which was Irish incorporated, but was resident for tax purposes in a non-treaty jurisdiction, like, for example, Cayman or Bermuda. And under old Irish tax rules, it was possible for an Irish incorporated company to be tax resident in a non-treaty jurisdiction, but that's no longer the case. Irish tax residence rules were changed in 2014 as a preemptive measure prior to many of the BEPS actions in order to close that particular loophole and prevent structures like this from being set up. But pre-existing structures are grandfathered until the end of 2020, so that there are some double Irish structures that are potentially still out there benefiting from the old rules. So in terms of the structure itself, typically the non-resident Irish incorporated company would typically acquire all non-US IP rights from the US parent and enter into a cost share agreement for future development of the IP. And those non-US rights were then licensed to a second subsidiary Irish incorporated Irish tax resident operating company. And that company would typically have an active operating activity in Ireland with employees and substance in Ireland, and it would act as, for example, sales principal for the non-US sales for the group. And historically, this achieved a number of aims, like, for example, deferral of US taxes prior to US tax reform. because the Irish operating company was typically a disregarded entity from a US perspective. And then obviously the IP was kept offshore so that value and profits accumulated in a low or no tax jurisdiction, while the Irish trading subsidiary was subject to tax at a relatively low effective rate in Ireland. Then obviously since then there have been a number of measures over the last 2 years that make these structures more difficult to sustain. Hans has touched on some of these already. These include, for example, new economic substance rules which came into effect in offshore jurisdictions, including Bermuda, which required the IP owner in these jurisdictions to have economic presence there, which is commensurate with their activities. Hans mentioned changes to transfer pricing rules, so adoption of 2017 OECD transfer pricing guidelines, including DEMPI principles, etc., that make these kind of structures just more difficult to sustain. In addition to that, as I mentioned, Ireland changed its tax residence rules in 2014 to prevent Irish incorporated companies from being tax residents in non-treaty jurisdictions, so essentially shutting down double Irish structures. The new rules came into effect from 1 January 2015 for companies that were incorporated after that date, but pre-existing Irish structures were grandfathered until 31 December 2020. So as this grandfathering is now coming to an end, those double Irish structures have already been restructured, will be required to do so before the end of this year. So I think there are just a number of the factors pushing companies to consider onshoring. And then obviously in addition to that, many European jurisdictions offer IP-related tax incentives for companies that bring on IP onshore. So for example, in Ireland, we have incentives like tax depreciation allowances, etc., for capital costs incurred on acquiring the IP into the Irish company. But I think for companies that had double Irish structures in existence already, Ireland is probably a rather natural home for them in that they already had an Irish operating subsidiary with substantive operations in Ireland that was taxed at a relatively favourable 12.5% rate. Then looking at the structure of how we've seen these transactions and the form that they've taken, most Irish onshoring transactions have taken a similar form. The IP is generally transferred out of the non-resident parent company to the Irish operating company in exchange for a loan note. The loan note can be interest-bearing in order to create additional tax deductions. However, there is a cap on the combined deductions that can be taken for IP tax depreciation allowances and for financing costs, and that's capped at 80% of the income of the Irish company from exploitation of the IP in any given year. But thinking then about the pitfalls and matters that require care in the context of these kinds of onshoring transactions, I think as a starting point, it's always important to ensure that you meet the relevant conditions in order for the Irish acquiring company to avail of tax depreciation allowances. So one of the requirements is that the company needs to incur a cost in acquiring the IP. Issuing a loan note as consideration is generally sufficient to meet that requirement. But if, for example, the Irish company were to issue shares as consideration, that's not generally considered to represent a cost incurred by the Irish company that would meet the requirements to qualify for tax depreciation allowances. It's customary also for the company to get an external IP valuation to substantiate the price paid by the Irish company for the acquisition of the IP. And obviously that then is the amount on which IP allowances will be claimed in the future. From an audit perspective, this is an important element. And it's one point that we have seen arise is how that value interacts with the financial reporting valuation that's used. And this is something that should be considered carefully by the valuation team in order to mitigate any potential risk in a future audit scenario. I mentioned earlier the changes to Ireland's tax residence rules in 2014 that closed the loophole allowing Irish incorporated companies to be tax resident in non-treaty countries. For companies, as I said, incorporated before 1 January 2015, these rules generally don't take effect until 31 December 2020, so the end of this year. But there was a concern on the part of the Irish government when they introduced the provision that that the grandfathering rules could allow old companies to be used to set up new double Irish structures that in that period between 2015 and 2020, which would have been contrary to the intention to phase out the double Irish structure. And for that reason, there are anti-avoidance provisions that trigger an early onset of the new rules for companies that are incorporated prior to 1 January 2015, if there's been both a change of ownership of the company and a major change in the nature of the business of the company within a specific period. And so when this occurs, the Irish incorporated non-Irish resident company becomes Irish tax resident retrospectively with effect from the date of that change of ownership. So clearly this would have a very negative impact. So these are rules that need to be navigated very carefully. If you're completing an onshoring transaction that's undertaken by a company in a double Irish structure that has undergone a change of ownership post 1 January 2015. We have found that it's possible to successfully navigate these rules, but it is something that needs to be considered carefully in terms of the various steps. Then one final point to mention when considering pitfalls related to these kinds of transactions is that Ireland, like all other EU jurisdictions, now has anti-hybrid rules since 1 January of this year. These rules often need to be considered in connection with IP onshoring transactions because the offshore IP owner is typically a disregarded entity from a US perspective, making it a hybrid entity. And as part of the onshoring transaction, the Irish acquiring company makes a payment to the IP owner that gives rise to a tax deduction by way of tax depreciation allowances in Ireland. So while this is the case and the rules typically need to be considered, we have generally found that the anti-hybrid rules are not problematic, as the non-inclusion in the IP owner jurisdiction is not caused by hybridity, but rather it's caused by the fact that the company is tax resident in a zero tax jurisdiction. We'll finish there. Thank you.
Gunnar. Thank you. Obviously, you will know that Germany has somewhat general culture in terms of taxes, and is more of a high tax jurisdiction, particularly as compared to Ireland. And therefore, the setup that you will find involving any German ownership is slightly different. Firstly, the US structure using double Irish companies will only be of interest to any German basis issue, to the extent that either you have a German shareholder or something where German CFC rules would have kicked in the past. And given that we have these CFC rules, there are hardly any structures like these under a German entity. Where Germany was to be the acquiring entity when you onshore your IP, you will find that while Germany might, in theory, grant a step up, this is bought at a rather high price, given that our tax rates are comparably high, and that there are no incentives for IP taxation, things like that. Also, any acquisition cost paid to, for example, such a double Irish structure would usually fall short of the German anti-hybrid rule, because Germany interprets these rather strictly. And we've seen issues where our relatively broadly worded anti-hybrid rules are even used to attack rather simple structures, and where you even start discussing whether the general system of US taxation gives rise to hybrid issues, and then puts you in a defensive position in defending your tax position. Given that there's no tax on the sale of the IP rights, it's relatively evident that Germany will not grant you a beneficial step up if you onshore to Germany. Having said all that, you will probably disregard Germany as your ultimate target location for getting the IP out. But even if you find another location, such as, say, the Netherlands, you still need to be wary of the German taxman. And that is something that we've seen evolve quite harshly over the last couple of weeks. Germany lays claim to a taxing right wherever IP is concerned that is somewhat linked to Germany, and the links that you can use are rather thin. So obviously in any structure where you have a German entity involved in your IP transactions, somebody who's paying royalties or paying a purchase price or an indefinite or a fully paid out license, Germany might, if the recipient is not a resident in the EU, tax a payment by way of a withholding tax. That same system applies to the extent that you do, for example, use other structures where the German entity is somewhat involved. But that is not where we end our claims. We've had a couple of cases that have just been discussed with the tax authorities rather recently, where in a typical Irish onshoring transaction using an offshore resident company selling its IP rights, say to the Netherlands, where there's no German entity involved whatsoever, Germany would probably, at least under the wording of our law, have a claim for taxes. Why is that? We do also lay claim to any tax for IP rights, which, for example, are registered in Germany. Now, that doesn't necessarily mean that everything is taxable in Germany, and that opens up tons of transfer pricing discussions. But in essence, since the European Patent Office is located in Munich, Germany claims that anything registered in that for that European Patent Office in Munich should be subject to German withholding taxes. And then if you have an onshoring transaction, obviously, that usually involves moving a lot of IP from one entity to another, thereby creating a relatively high value taxable event in the first place. And then you start fending off how much of that might then end up being subject to German taxation. All of that is, one has to say, still under debate. We've seen the issue being brought up by the Big Four about 3-4 months ago, and then being told and discussed with virtually any larger US corporate. And there have been intensive discussions with the revenue going on ever since. The revenue has taken a rather aggressive stance in all these discussions, saying, well, that's the wording of our law and it's meant to be that way, and we want to have these taxes, so please do report everything you possibly could and pay up. It is quite amusing because for some of the years they found it very hard to even tell anyone which authority would be in charge, but we have a clear allocation for everything that happens from 2013 onwards, where the Federal Tax Office in Germany would be in charge of collecting withholding taxes. We do now see that there's more or less a general approach taken by anybody involved, where royalties are now paid between non-German entities, or where such transactions have happened, that you will probably highlight the existence of these transactions to the Federal Tax Office and make a sort of disclosure of the fact that this happened. And then probably also file whatever terms of payment for royalties has happened in the second quarter of 2020, which is the amount that would now be due for reporting. And then discuss it from there to see whether there's anything that in fact really needs to be taxed in Germany with a certain withholding tax. But you can imagine that given the many onshoring transactions that have happened ever since Ireland started changing its rules, there are tons of transactions where even remotely Germany will have been involved, because any patent rights registered will also have been registered in Germany, where a certain amount of that transaction may end up with a German withholding tax hit, which, given that there's no German entity involved on either side, no credit will be available. So it's quite something to discuss, and may take a bit of a bite out of whatever benefit you may have wanted to derive from the onshoring structure. That, I think, is the small warning word I can give at the moment for where we stand in Germany.
Thanks, Gunnar. Well, the Netherlands is, let me just call it, a little bit in the news last couple of months, probably with a more deteriorating tax system. Hopefully it's going to change soon, since we had a message more or less this week that a company like Shell is going to relocate to the UK, probably due to dividend withholding taxes. So, but still, it's not all that bad. From onshoring perspective, the Netherlands is not that bad, simply because whenever you would sell an IP right from an offshore location to a Dutch company, we would give a step up. You cannot rule it, by the way, but it's based on Dutch tax law, case law. You have to get a step up, which you can depreciate. And of course, the next step is, whenever the IP is in the Netherlands, can you benefit from some other patent box kind of regimes? And we have the same thing in the Netherlands. So if there is a development, continuous development, cost sharing arrangement, whatever, with that IP, it's still possible to also enjoy beneficial taxing right in the Netherlands. The regular rate under the patent box is 9% at the moment. It's probably going down to 7% again soon. It's been expected. For all locations, by the way, whether it's Ireland or the Netherlands, people have to be aware that this is something which falls under the mandatory disclosure rules, C1C, the payment which benefits from a partial or full exemption from tax in the jurisdiction where the recipient is resident for tax purposes. So you have to notify to the tax administration that you apply a structure like this one, but that's just notification. We have no idea yet what will happen with it, of course. But from a Dutch perspective, as said, Airbnb is one of the first who did an onshoring in the Netherlands. And there has been some discussion going on about this because in the Netherlands, politicians the last couple of months were not that positive about multinationals. It's changing happily again, but still, in that debate, it's been confirmed that there is no anti-hybrid rule possible like in Ireland, simply because Bermuda, for example, has a 0% tax rate, so it's not a hybrid structure as such. So the step up is going to be given. Depreciation is possible. Patent box regimes are possible. Notification will take place, of course. Further on, I think. Yeah, that's it. So it's a location. One last remark: it's not that it's without discussion in the Netherlands that we give depreciation for a sale which is not taxable in the other country. So there are discussions going on whether we should change that. Of course, it cannot work retroactively. So the discussions are still discussions, so it can take some time before that's going to be done. It's still because by onshoring IP, normally in locations where you also co-develop or develop that intellectual property right again, it creates a lot of workforce there, and from that perspective, it's expected that's not going to be an easy way forward to change Dutch law. But until now, and probably until at least a couple of years, and hopefully a length of years, it's possible to do the onshoring in the Netherlands. As said, you won't get a ruling for this simply because the Dutch ruling policy has changed, and we here have to deal with a corporation which is taxed at the 0% tax rate, and which is also often the well-known offshore locations, and therefore it's excluded from the tax rulings. But nevertheless, the case law as such is the strongest push forward here for making this possible. That was it from Dutch perspective. Marina, last famous words for you.
Yeah, thank you so much, guys. That was a very interesting session to hear about the three different perspectives, with Germany being very conservative, trying to control that even if a German entity is not involved. Tax policy is definitely changing. You can see that after the UX tax reform and BEPS they've had. So we can see that being spilled out in these different three jurisdictions. So thank you for this overview. It was very helpful. The video and this interview session will be available in the GTC website, meet our members. So I hope and see each other again in another webinar session. Thanks so much.
You're very welcome.
Thank you.
Thank you.
Thank you. Have a nice day. Bye-bye.
Same to you. Bye-bye.